What's up, y'all? My name is Trey. This is Investing by Numbers. We talk all things stock market. We look for stocks that are in good value territories, talk about education on how to invest in great companies, great prices, all that stuff. So if you're into that kind of thing, please like the video. It helps us out a lot, especially since we're a small channel. And subscribe. Keep up with our channel. I call out new companies, that I'm looking at that have possible great returns over the coming months to years. And a few of those that we've called out on this channel have done really well over the past few months. So stay tuned. I've also got a new pick at the end of this video. I'm going to talk about a new company that I might be putting some money into over the coming weeks. So stick around. We're going to talk about what's going on in the stock market right now. We're kind of getting into a new bull market after we've kind of resolved these tariff wars situations going on, especially with China over the past few days. So we're seeing the stock market rally, and we're going to talk about what stocks are still a good value. Sometimes right now during these periods, it can be really tough after we saw those low numbers on stocks. As prices come up, it's hard to tell what's still a good value since we're seeing 20-30% up from just over a month ago. But there are still some great companies out there that are going for great prices in reference to their overall fundamentals, and we're going to talk about those and just kind of look at what the market's doing. And I'm going to show you what my portfolio's done over the past couple months. We took some hits there for a while, but if you stayed in it, if you kept invested, you've done really well. And if you were able to put more money into the market, over the past few weeks as we hit new lows, you've done very well since if you picked the right companies. Anyways, let's look at the market and let's look at the companies I'm invested in and what I'm still looking to invest in over the next few weeks. Okay, so here we are looking at SPY, which is the ETF of the S&P 500. And as you can see back here on February 19th, we hit new all-time highs at the time, just around $613 a share. And then we dropped all the way down on this Monday, April the 7th it was, down to almost under $482 a share. So this was we hit just around that 20% down from all-time highs. On that Monday morning on April the 7th is when I put extra money I had put aside into the market. And we'll go over what I bought here in a few moments and see how it's done. And just, when everyone else was panicking, guys, that's what we're looking to do is pick up great companies at great prices, and that's what we did on that Monday morning as the market hit 20% or more down from all-time highs. But since you see how fast things happen, all right? I mean, we went from around February 19th to 20% down April 8th, about 6 weeks it took to get to 20% down. And then just in the last 3 or 4 weeks, we're closing in on back to all-time highs. These things happen really fast, guys, especially when the president who's in office has a lot of power over why the market was crashing. With Trump's tariffs, a lot of people were freaking out, massive sell-offs, and as he came to resolutions very quickly, people were buying back in again. Now, here's the important thing to think about, guys, when this stuff happens is during this time period, people were freaking out. I had people on my Facebook page that were, telling everyone to sell their retirement portfolios, that, everything was going to crash 50 to 60%. I was pretty vocal about wanting to buy when we hit that 20% range, but people were saying, oh no, they're waiting for 40% down, 50% down, stuff like that. But, guys, you can't time the market. And these 20% down from all-time highs, they only happen, once every few years. So when these things happen, that's when I'm looking to invest more money than I normally do. I'm always buying stocks. I spend 25% of my pre-taxed income on stocks. So anytime I get a paycheck, I'm putting 25% of it into stocks, into my retirement portfolio. I'm not looking to take any money out of my two portfolios anytime soon, but maybe over the next coming years, whether it be to pay taxes or something like that, I might pull some money out. But right now, I'm not looking to do that. I'm looking to grow this thing as much as possible. So let's check out. This is my Robinhood account, and this is my active account. This is the money I put money into every week whenever I get a paycheck. My Charles Schwab account is more of my portfolio that I just manage. I'm not adding any money to that right now. Once my Robinhood account equals the same amount as my Schwab account, which probably will be coming up fairly soon, then maybe I'll put more in my Schwab account, but I'm not really sure about that. We'll see when the time comes. But you can see with this account, we are at all-time highs in this account, even though the S&P 500 is still trailing all-time highs. Interestingly enough, just this past week, my overall portfolio between both accounts flipped into profitability on the year. I think right now my portfolio is up around 4.5% in 2025. So that's awesome. That shows that we're beating the market right now. I think the overall market's still down around 0.5% or maybe 1%, somewhere right around there. So we're doing really well. And this is what I talk about, guys. If we had a full year, let's say in 2025, the overall market was down throughout the whole year, most likely I would underperform the market, because my stocks are going to go down harder than the overall market. But when the market goes up, my stocks are going to rally harder than the market rallies. So that's why we see these how to beat the market and stuff like that. You want to be picking great companies at great prices. And if you can do that, you can definitely outperform the market in the long term. There might be, 1 or 2 years out of 10 that you don't. But if you're picking the right stocks, if you're buying at the right prices, if you have the education, you can definitely beat the market. And with a little bit of time and knowledge, even if you're new at this, guys, you can definitely beat the market as long as you're willing to put the time and effort into it. So I'm going to check out, I'll show you my personal portfolio here and the stocks I'm holding. This portfolio is just over 87,000, and my Schwab account over here is up around over 103. Now, my Robinhood account is at all-time highs for the account. This account is not. I think prior to the last crash when the market was at all-time highs, somewhere around February, this account was close to 115K. So this one's not at all-time highs, but my Robinhood account is. But between both accounts, my overall portfolio is at all-time highs. But that includes the money I invested throughout the last dip. But let's look at the stocks I'm holding right now. All right, Alibaba, I've been holding this for a little over a year, since last February or March. It's up over 83%. That's doing really well. Not looking to sell anytime soon, but maybe over the next couple of years, I might trim some of that position if it gets into overvalued territory. Nvidia, I'm super excited about. I was waiting to pick Nvidia up, and I've been picking up as much as possible. I'm a buyer of Nvidia. Anything under about $145 a share right now. Now, when they report earnings, that number might change based on their trailing PE. But right now, I think Nvidia is a good buy under a 50 PE, and that's around $148 a share. So for me, anywhere up to $145, I'll keep picking up Nvidia. I think they are not anywhere close to being done with growth. And I look forward to picking up more and more shares. I got shares of Nvidia in this account and my Schwab account. Nike, I'm down 21%. I've been buying Nike since, probably the last 6 months or so. Nike was a stock I was buying when the market was at all-time highs. But right now that there's so many good deals out there, and there's still good deals out there, even as the market's coming back up, I'm not looking to pick up any more shares right now. But as a lot of these companies start to get back into fair value range, if Nike is still down at these levels, I probably will pick up some more Nike. But I don't expect Nike to see the comeback as some of these other companies. Therefore, for me, Nike, I'm just holding for now. PayPal I've been holding for a few years. I've been a little disappointed with PayPal's performance. I thought it would really do a lot better over the last couple years, but still I'm up over 20% on this position. And as it hits, new recent highs, maybe over the next coming months, if it does, I might start trimming some of this position. I might sell off half of it or so if there's good deals out there elsewhere where I think that money could go. But still, I think PayPal is a solid company. It's a hold for me right now. I'm not looking to pick up any extra shares. Air Test Systems, this one's gotten hammered over the last few months. I own a little more of this than I'd like to at my cost basis. This is a company that I'd like to keep under 5% at my cost basis, but I went a little heavy in this company, and I'm probably sitting more around like 6 or 7% at my cost basis. So I think it's a good deal right now. This is kind of a stock that's a little uncertain, so I definitely would keep it under 5%. I do like the levels it's at right now. I just don't want to pick up any more. I see Air doing very well over the coming years. It might take it a couple years to really pick up some momentum, but this play for me is decades out. They're a smaller company, but they manufacture test systems for AI chips and other chips and whatnot. Shopify. Shopify is my biggest position between both accounts. This one's over a double up, but it's a small position. But I've got a very large position in my Schwab account, which I would say overall I'm up somewhere around 65% on that position overall, but it's probably about 2/3 of my entire portfolio. I'm not looking to trim anything yet, but as Shopify hits new all-time highs, if it does over the coming year or two, I'll probably start trimming some of that position as long as there's other opportunities out there to invest those profits into. So Shopify, now a couple weeks ago, Shopify was kind of at a low point, and I considered it a buy. Right now, it's returned pretty solid. So I would say this one's still a hold for me. Celsius is a stock we've been calling out for a few months on this channel, and it's done extremely well. We're up over 50% of this position. I've only been buying Celsius probably for about 3 months or so, maybe less, and so it's done really well. It's not a buy for me at the moment. It's just a hold. Right now they're over 100 trailing PE, so that's high for me, but I want to hold this thing for at least a year before I start taking any profits. But to be completely honest, most likely I'd like to hold this thing for another few years before potentially taking profits, but we'll see. If it hits new all-time highs in the next year to 2 years, then I probably will trim some of my position, but we'll see from there. Adobe, I'm up just around 4%. This is a buy for me still right now. Right now it's at $340 a share. I'm still very willing to, I'd pick up as much Adobe as I could under maybe around like $375 a share. So I'm not looking to cap this thing anytime soon. I still think Adobe is an extremely great position. Okta was one of those lesser known companies we called out, a month or two ago. And as soon as I started buying this stock, it started running, and it's up over 43%. And this is one we called out, guys, and it's done really well. For me right now, it's a hold. I'm not looking to pick up any more shares of it, but I'm definitely looking to hold this thing over the coming years. Smaller position, but still great return for over the last couple months. ELF for me is a great stock. I love ELF. We've had great returns. We've only been holding this stock for maybe 4 to 6 weeks, and we're already up over 25% on this thing. I'm definitely a buyer of ELF under about $85 a share. Right now it's somewhere around 77, 78, but I'm a buyer of ELF up to around $85 a share. I think that's a great value range for it, roughly under a 50 PE. Now, the last one on the list is GCT. GCT I've been talking about for a couple months. I made a whole video about GCT a few months ago, and I'll post that. I'll tag it at the end of this video. And I said that it was a possible stock that could surge over the coming months to year to 2 years. And I picked up shares just last week for the first time. I was kind of waiting on this one. I wasn't buying it mainly because the stocks I were buying, like Adobe and ELF and NVIDIA, were at such good ranges. But as those started to come up, I decided to go ahead and pull the trigger on GCT. And I think I bought it the day before they announced earnings. And after they announced earnings, they knocked it out of the park. And we're up almost 38% in just around a week, or just over a week. So congratulations to anyone that's been buying GCT over the past few months. It's really starting to turn around and do great things. Doesn't mean that it can't, drop again, but if it drops again, I'll be looking to pick up more shares. This is another stock that I'm looking to keep capped at around 5% of my portfolio, just because it's a newer company, and you want to stay safe with these because you never know what could happen with them. But it's a profitable company. They've got great numbers. They got a good balance sheet, and I'm liking GCT. So as we can see, we've got just around 87,500 in this account. My Schwab account, I've got just under 104. My Robinhood account, of course, it's at all-time highs. This account is not. I think all-time high for this account was about 115. But overall, between both portfolios, we're around 191K, and that's an all-time high for me for my portfolios. All right, guys, I'm just going to update y'all on the stocks I bought on April 7th when we hit all-time lows. Not all time, but recent lows, the 20% down from all-time highs. I bought 3 stocks, okay? I bought, where are we at here? Let's see. I bought NVIDIA, and I'm just so you know I'm not playing you. I'll show you where I bought. Down here. So April 7th, I picked up 17 shares at 88.08. Adobe is another one I bought. Adobe on April 7th, I bought 4.65 shares at just under $337 a share. And the third stock I bought on that day was ELF. And ELF on April 7th was 30 shares at $50.58. So I've got that written down here. That was April 7th, just over a month ago, when the market hit 20% down from all-time highs. I spent almost $4,600 on stocks that day. And here's what I bought, a list as you saw. And since then, from these shares, my overall profit's been almost $1,900, which is around a 41% gain in a month. Okay, so wow, the amount of money you can make very quickly when we hit these times. Now, this was when people were panicking, guys, and that's what this channel's about. I'm not putting this on here to brag. It's just to show you that when people are freaking out and in fear, it's the time to start picking up stocks. Now, this was a rare case, all right? It's very rare that the market dips down to just at 20% and then returns, to a bull market. That doesn't happen very often. Most of the time when we see a 20% move, it is the result of a stock market crash, and usually it's going to take another year to 2 years before we get back to all-time highs. But how I play the game is I invest 25% of my pre-tax income no matter what. I try to buy the best deals I can find out there in the stock market with the best companies. But if the S&P 500 is down below 20% from all-time highs, anything extra I have in my bank account over my emergency fund, obviously, I invest. So I'm investing more into the market when the market is down than I am when it's up. And a lot of people, it's the opposite. They start putting a lot of money into the market when it's in a bull market. And the problem is if you're not paying attention and you're buying stuff that's already overvalued in the bull market, you will not beat the market, because the best time to buy is when the market's down. And if the market's down, it's good to hold. You don't want to try to time the market, guys. This is a losing effort, because what happens if you sold all your shares in your entire portfolio on April the 7th when we hit that place? A lot of people were saying that we were going to see 40 to 50% down from all-time highs. People were freaking out. You missed a huge run. And what happens? Are you buying back in now? You lost a lot of money if you sold out back at the beginning of April and bought back in the last week or so. You missed a lot of money. You lost a lot of money. And if you did that, that's okay. Take it as a lesson learned. Keep holding, keep buying stocks at great prices. And if you do that for the long term, you will do very well. And if you can learn how to pick these companies, if you learn how to read the fundamentals and decide when they're at good value ranges, even if they stay down below where they bought them, but where you bought them at for over a year, do you have the confidence to keep buying? That's what you want. You want to be buying companies that no matter what they do, you're still picking up shares. And then when the market returns, or when that company starts kind of recovering from a rough period, you will rake in the profits, guys. You will make money. And if you can do this year after year after year, you will do fantastic. And, if you're dedicated to investing your money, on a weekly or monthly basis, no matter what, and you keep learning and you keep researching stocks, you will do very well. You will be a millionaire if you push yourself and you are patient. Warren Buffett always says that for some reason, no one wants to get rich slowly. But as investors, we're not focused on tomorrow or next month. We're looking at years out, and we are looking to build our wealth over time. But before we end this video, I want to talk about a new stock I'm looking to invest in, and that is Zeta. Zeta is a software company. It's a marketing software company, and their price has been very beat down over the last year or so. We hit all-time highs around $35, $36 a share, and right now we're under $15 a share. And this company's got fantastic numbers. They are not profitable yet, but they've got a clear path, in my opinion, to profitability. Quarterly revenues have been increasing up and to the right. Net income has been also quarterly. We just hit a profitable quarter this past quarter. So look, we had a steady, this is what we want to see. If we have a company that's not profitable yet, we want to see this clear picture of increasing net incomes towards the positive. And look, we had our first positive quarter last quarter, and numbers have been very good. Now let's check out their income statement and their revenue growth, over the past few years. And in 2019, 306 million, roughly, around a 20% move into 2020, and then around another 25% move into 2021, another 20% move or so into 2022, and another one into 2023, and roughly a 30 to 35% move into 2024. So we've got fantastic revenue growth. Net income growth also has been doing pretty well at the same time. And let's check out their balance sheet. This is another thing with a company that's just getting into profitability or not quite completely profitable yet. I really want to see a good balance sheet, because that's really going to decide on how well the company's being run, and if they have a lot of risk attached to the balance sheet. Cash on hand looks good. I like to see these numbers improving over time, and we've had an influx of cash over the past couple quarters. And this is what I like to see here. Total assets, 1.1 billion to total liabilities, 434 million. I like to see 50% or more total assets, total liabilities, preferably a double up, and we have over a double up here. We have almost a 3x from liabilities to assets. And look at this, our cash on hand almost, covers most of our total liabilities. It definitely well covers our long-term debt. So great balance sheet. When it comes to companies like this, we can't use a trailing PE, but I like to use a forward PE when I'm looking at companies that are just starting to break into profitability. And as you can see here, coming down on Yahoo Finance, we've got a forward PE. I think it's actually under a 20 right now. Well, it says 23. I'd probably go with that, but that's relatively low for what we've seen, over the past year or so. So we've got a low forward PE, and we're just starting to move into profitability. This is a company that I think is going to do really well over the coming years, and I will release a video on Zeta more in depth. We're going to check out some conference calls and really look more into the numbers, do some evaluations on where the share price might be in the next 5 years. So stick around for that. I'll probably release that later on in the week. But thanks for tuning in. Just a reminder, guys, this, just because we're in a bull market now doesn't mean that we're going to hit all-time highs and continue to hit them. Things could always reverse, and that's why we play it safe. We invest our money into great companies at great prices. That's what we do here. That's what we do as investors, and it's fun, guys. It's fun, and especially right now when the market's going up, it's fun to watch your portfolio go up. But it's also difficult to purchase shares of these companies at higher prices than we did a month ago when we were getting amazing deals. But that's what we do. We can't control what the market does. All we can control is how much we invest and what we buy at the prices we decide to buy at. Anyways, that's it for me, guys. Can't wait to catch y'all in the next video. Please like and subscribe, and have a great rest of your day.